is here right now. Steve.
The Federal Reserve raising by 1/4 point, by 25 basis points to a new range of 4.75 to 5%. It is the 9th hike in a row since the Fed began hiking in May 2022. The Fed providing some guidance saying additional policy firming may be appropriate. That's perhaps a bit of a downgrade from what they said last time, where they said ongoing increases in the policy rate may be appropriate. Now they're saying additional firming. We'll have to talk what that means. Now, they said recent developments, which seems like a euphemism perhaps for the recent turmoil in the banking market. They said recent developments are likely to result in tighter credit conditions for households and businesses. Those tighter credit conditions will weigh on economic activity, hiring, and inflation. The extent of these effects, however, is uncertain. Now, they left unchanged their year-end projection for the funds rate at 5.13%, which suggests they believe they'll be hiking at least 1 more quarter point and then be done. They raised next year's funds rate projection to 4.3%, which you'll notice is below the projection for the year-end. So there are some cuts built in by the Fed next year, but a little bit less than there had been before. They forecast a bit more inflation this year at 3.6 versus 3.5 for the core PCE. They said inflation remains elevated. Remember last time they said it had eased somewhat. That was gone from this particular statement. They said the U.S. banking system remains sound and resilient. On the economy, modest growth in spending and production, they've noted. Job gains have picked up and running at a robust pace. Guys, the one thing I'll notice from this thing is first the change in language for some additional firming may be appropriate. The other thing is almost no connection at all from their comments about the impact of tighter credit to the effects on the economy with policy, except for that little squishy language about what happens next.